Hello, everyone. Welcome back to the Midnight Markets podcast. My name is Sofia Cruz, and here we break down trending financial topics with insights from the sharpest minds in the industry. Today, we have a super special guest. Hi, Xander. How are you?
Good. How are you? Thank you so much for having me.
No, thank you for making time to spend with us today. Guys, for your information, Xander's worked in one of the most prestigious firms across the world. He's worked with the U.S. Department of Treasury, and now he's currently working with Goldman Sachs, right?
Mm-hmm.
Yeah, so I believe your experience amazing. Can you tell us more about how you got into it?
Yeah. So I give everyone the same spiel. So I don't know how diverse of a crowd this reaches, but if it's the same people I speak to quite frequently in the business school, then they've heard this before. But I'll give you the bits and pieces right now. First of all, thank you guys so much for having me. It's pretty cool. Big podcast fan. I've never seen a setup like this, so it's fun to be here. So I came to GW as a art history major, actually, and was very dead set on pursuing a career in the humanities, whatever that entailed. Wasn't quite sure at the time. And I got involved in a number of professional organizations in and around the business school in my early years/months at GW because I knew I needed professional exposure regardless of the industry I was going into. Long story short, when I got more involved in those organizations, in the business school, I kind of fell in love with economics and finance as academic disciplines, but also as industries because the students that I was speaking to that worked in the industry and the alumni that I connected with were just incredible, smart, hardworking people, and I knew I wanted to be a part of that environment. So kind of just to fast track my career, I got as connected as possible within the business school and started speaking to alumni pretty frequently and found that wealth management was going to be the career path for me. And intermittently, I had experience at a credit rating agency up in New York City and then here at the Department of the Treasury, which I highly recommend for students in D.C. getting involved in the policy space. It was a fascinating experience, particularly because I was working in the Middle East and North Africa office, which was a fascinating office to be in. So found out that wealth management was the career path I wanted and applied, networked pretty aggressively at a bunch of different firms, but ended up at Goldman in San Francisco. So, yeah.
That's so nice. San Francisco, yeah.
Yeah.
Well, you have tons of expertise with different sectors that we don't even think about sometimes, but they have a really big impact on finance. So, as you've seen, latest news, S&P 500, Nasdaq, Dow Jones, down 2% this Friday.
Yeah.
That was big news, and a lot of people were super concerned on what does this mean for the market?
Yeah.
Is this volatility forever, or could this be heading to a more significant pullback? What do you think?
Yeah, so preface by saying this is not investment advice. I don't consider myself an expert despite that great introduction you gave. So I think a lot of, and I was just speaking to someone who I was helping prepare for an interview just a few minutes ago, actually. And I think a lot of what we're seeing right now is kind of the shell shock of what's been an extremely rapid and aggressive pace of policymaking and announcements from a new administration that we knew was going to be a bit more showy in the way that they announced what they were going to do, but I don't think markets were fully prepared for that. I think, at its most basic level, they knew that a increasingly conservative administration and an administration that announced that it was going to be looser from a regulatory perspective was going to be good for markets, good for business, good for investment, good for M&A activity for those who are interested in banking. But I think what we're seeing now is and I hate to use this word so frequently because I think it's so overused, but an extreme environment where we're seeing a lot of heightened uncertainty in terms of what the policy outlook is going to be and what's going to impact fundamentals versus what's simply a negotiating tactic. And I think that's what we're seeing markets react to. But in addition, I think more importantly, when we talk about fundamental economic analysis and economic indicators, over the past few weeks, we've been seeing signs that maybe we're on the precipice of the economic recession we've been talking about since I was a freshman at GW when I first started getting interested in markets and economics when the Fed started raising interest rates in the late winter, early spring of 22. And I think now we're starting to see that. We're starting to see those long-term lag effects, slowing, cooler than expected retail sales, housing starts, stubbornly high inflation, but cooling consumer sentiment. So I think a lot of what we're going to be seeing over the next few weeks will tell us whether or not, with PCE data and Nvidia earnings coming out, will tell us a lot about whether or not the reactions that we're seeing are justified from an investments perspective.
Yeah, because as you've said, the Fed has a big impact on whatever it says, and especially whether it's politics or something new about a policy or anything that has some relation to that, it has a ripple effect throughout the markets, and it's inevitable. So the Fed, it closely watches the PCE report.
Absolutely, yeah.
And that's their favorite measure of inflation, as we know.
Supposedly, yeah.
But here's the thing. Why do you think the impact of the PCE is going to be big for the Fed and the perspective they have on interest rates currently?
Look, I as a 21-year-old not yet graduated college, I have no reason to argue against what the Fed claims its most important measure is. So I think absolutely, at least from an academic perspective, that the Fed says that's what they pay attention to the most, then that's what I should think they pay attention to the most. So I think this week, it comes out Friday, right?
Friday, I believe, yeah.
I think the PCE data is going to be crucial, and I think we saw hotter than expected or hotter than wanted CPI data just a few weeks ago. And so I think the PCE data is going to kind of be the conclusion of what we've been observing over the last few weeks, whether or not it's higher or lower than projections make it out to be, and whether or not it's any closer to the Fed's 2% goal is going to be indicative of how they kind of approach these next few months from a policy perspective. But I don't say that to discount the fact that I'm sure they're paying attention to all the other economic indicators, and I think that's clear when we look at. I think we got their minutes from their January meeting. Their January meeting just last week, where they show that they're not afraid to hold interest rates at a higher point for a longer period of time. That higher for longer environment we've been talking about repetitively for the past few years. And I think that a lot of that rides on what the PCE data is going to look like at the end of this week. So yeah.
Yeah, and now we're gonna switch to a more private company field.
Yep.
As you've heard, Apple.
Yep.
They're making big changes. Their chip manufacturing and everything related to AI. So, as we all know, Nvidia is like the big guy on AI. So, do you think this signals that Apple is trying to compete in that field, or do you think they're just trying to make it seem that they're taking back their supply chain control?
I think partially it's them trying to become more dominant in the field. I think we've seen increasing competition since this boom started a few years ago, with Microsoft announcing huge investments, the U.S. government subsidizing and incentivizing huge projects in AI investment and chip development. And I think because Apple has proven that it has the proper business fundamentals and cash flow to continue to make these investments and expand its capital expenditure, similar to companies like Meta revealed they do in their last earnings report, then there should be no reason why they should let up on that front. But to bring up that third option that I said I was going to talk about, I think this is also a reaction to the policy developments that we've been observing over the past few months. As much as I hate to say it, I think a lot of this threat around tariffs and making the U.S. a more independent, self-sustaining economy, especially from a technology perspective when we're competing with an economy as large as China that we consider an economic adversary in a lot of ways. I think companies in the U.S. that are kind of staples of that technology industry, like Apple, who've been in that space for such a long time, are going to try to make sure that they shore up their defenses, I guess for lack of a better word, to make sure that if at any point in time their ability to do business with someone as large as China is hindered from a policy perspective, so from a legal perspective, then they want to make sure that they have the resources domestically to be able to continue to expand that AI business. So I think it's a combination of the things you said, in addition to kind of a reactionary stance from a policy perspective.
And that definitely creates more confidence on investors and the company, right?
Yeah. One would hope, and I think a lot of this again rides on earnings reports, particularly for Nvidia. And I know we saw strong earnings from a lot of these companies just a few weeks ago, and I think it'll continue to be dependent on that, like whether or not the capital expenditure that companies are undergoing for these huge investments that we haven't necessarily seen full returns on, and probably won't see for the next few months, if not years, is a tough thing to base an investment decision on from a fundamentals perspective, right? It doesn't necessarily align with us seeing a production of cash flow, a production of returns from the immense amounts of capital expenditure. So I think a lot of it is going to come down to whether or not we trust that these companies and their business models, like Apple, like Meta, and the people who provide the materials for them to pursue those business ventures, like Nvidia, whether or not we think they sit within the AI industry as a whole in a way that's steadfast enough to kind of withstand any of the sort of intermittent economic volatility that we've been seeing over the past few weeks. I think that's going to be crucial.
Yeah, it's definitely going to be crucial. Thank you so much for your insights on these topics, because they're like one thing covers a different other.
Thank you so much for having me. This is pretty cool. Like I said earlier, as a podcast nut, it's cool to see all the headphones and lights and everything. So this has been awesome.
And for you, our listeners, thank you so much. If you stayed till this moment, please make sure you drop a like, subscribe, and comment. Please share with your friends. And if you are into more market updates, we have a daily newsletter, and you can subscribe to it in our social media platforms and our link trees. And make sure you stay updated. Thank you so much.
The Midnight Markets podcast by the GWU Stock and Portfolio Management Club features student discussions on finance and market trends. This content is informational only, not professional advice.